Hey world, it's being able to come back with another video. I want to do this video because I want to kind of see if I can help some individuals out there that are, thinking about, you know, their future and how they can actually secure additional income in the future by just basically paying yourself first. And what I want to do is come back with a couple of options that you can use to do that. And it's going to be based on life insurance, okay, and HSAs, all right, which are health savings accounts. Before I get started, I want to say thank you so much for subscribing to the channel and giving me your time. It's very humbling. I really appreciate it. And it's so interesting because one of the family members asked me to address the property tax issue because I know a lot of people, and it's very important, family, that you check your tax assessor forms to let you know exactly the tax rate that you pay in property taxes, the property value of your property, as well as the market value. Because a lot of times, if the market value for your house is way lower than the property value, then that you may need to try to find out what's going on with that, because you may be having to pay, you may be paying higher taxes than you need to. Because remember, tax assessors, when they do their appraisal and when they do give your house a value, a lot of times they just base it on the property values in your particular neighborhood. So if your value of your house is comparable to most of the homes in your neighborhood, then of course you're going to be paying a specific tax rate, as well as property taxes a year, right? Now what happens is when the property value goes up in your neighborhood, and how does that happen? It's so crazy, because if you live in a neighborhood and the value of your home's around $175,000 a year, and then you paying, I know here in Texas, the property tax rate, it differs based on the county you live in. I know some of the lowest property tax rates are in Louisiana, Oklahoma, states like that, where you can actually take advantage of owning property, owning land, and not having to pay such a substantial amount of money in taxes because the property tax rate is so low. But if you live in an area and your home taxes all of a sudden just go up, skyrocket, you need to know why that happens. Okay, because when the property taxes in your neighborhood go up, then somebody sold their home for a higher value than what it was worth. Okay, and see, that's kind of how they start the whole redlining situation, where you have 3 houses in your neighborhood, and the property value in your homes, from a median standpoint is 150, 175. Then somebody saw a person in the home for 400,000, 500,000. Then that's going to increase to your property tax rate, because they're paying higher taxes. And so as a community, your tax rate will go up. So you got to make sure you kind of stay vigilant on that type of information. Okay, so if you ever wonder why neighborhoods get, they change overnight, and a lot of people want to attribute to regentrification, but what exactly is regentrification? Okay, if values of the property in your neighborhood all of a sudden start going up, then that means the taxes are going to go up, and so they basically just kind of pushing you out because you can no longer afford to pay the taxes in that neighborhood. And so they call it regentrification, but it's something that's systemic and systematically done to pretty much change the culture of certain neighborhoods. Okay, so you want to kind of stay cognizant of that. All right, but back to what I was saying when it comes to establishing some additional income when you get older, especially for my younger audience. Guys, it's never too early to start looking into what they call life insurance policies. You have whole life insurance and you have what they call term life insurance. Now, we need to kind of understand the difference, because a lot of times people think when they purchase life insurance, you're just doing it for the people, your beneficiaries. But no, you also can take advantage of the premiums or the monthly payments that you pay in that life insurance over time. If you are paying yourself first, and I mean not only just financially, but health-wise, meaning you're eating healthy, you're drinking a lot of water, you're taking care of yourself, you're staying stress-free, you're going to live a long life, right? And so it's always cool to get you some whole life insurance, because at a certain amount of time, the money that you build up in that life insurance policy can be used, okay, as income. as well as what they call a ROP, a ROP, term life insurance. That's called a return of premium. So if you got a 7-year or 10-year life insurance policy, which is a ROP term policy, and guys, make sure you look into it. At the end of that term, you can get your money back. Instead, now you're looking at a situation where you can actually have additional, cash from basically paying yourself first in a life insurance policy. All right. And also what they got called a HSA, called a health savings account. A lot of jobs offer it, but just kind of look into it. Do your research, because a health savings account can not only, and especially if you're healthy, this is very important. A health savings account can allow you to deduct $2,500 a year in taxes as a tax credit, right? But every year you paying $2,500 in that health savings account, and of course being healthy and not taking any medication, guys. I'm be honest with you. I'll be 52 years old here soon. I don't take any medications, prescribed and nothing else. And I exercise. I move more than I eat. And so I've been fortunate enough to make sure that my life can be lived without the assistance or aid of medications. And that's what you want. All right. And so health savings account can also be just an additional savings account that's building interest. And so after 10, 15 years, and you cool. Remember, at 59 and a half years old, all that money that you built in that health savings account over the years, that's your money at 59 and a half years old. Okay. So you have ROP, term life insurance policies, which are called return of premium. And return of premium means the monies that you pay every month, that's your premium payment. At the end of that term, you can get that money back. And of course, you can reinvest that and do whatever you want to do with it. But it's additional cash flow, family. Okay. So like I said, let me just reiterate. Property taxes, family, make sure you take, if you're homeowners, if you're landowners, if you're commercial builders owners, make sure that you kind of stay conscious of your taxes. You should know your tax rate, okay? And you should know what you're paying in taxes before you even pay them. And it's pretty simple to calculate. All you do is the property value of your location times the tax rate. And that's going to give you your taxes, or how much you owe, okay? And then, of course, family, look into those health savings accounts. Also look into whole life insurance policies, as well as ROP, term life insurance policies. Always good to have, family. All right? And so I just want to come back with a little food for thought, family, and hope this was information resonates with you. Still in Austin, Texas, enjoying myself. It's just a beautiful thing. And make sure you like, share, and subscribe. And in the meantime, between time, may the Most High Society bring you joy. And being with is out of 5,000.